Good morning, everybody. Paul here coming at you with a Crypto Coffee update, one of my favorite times of the week where we get to sit down and talk about the news, events, and some of the exciting features that we see here in the ever-growing crypto space. And, of course, we have a nice cup of coffee to get us started right, so if you'll please join me for our ceremonious simultaneous sip where we get caffeinated up for an exciting dive into the new world of digital finance. So, bottoms up, join me. Good stuff. And you can see we have open in front of us today Cryptide.cc, which is our lovely website. Please check us out whenever you have a free moment. It costs you nothing but your time, which we as well very much appreciate. After all, it would just be me talking into a camera if I didn't have you guys, and together we form a community. Now let's go ahead and do what we do best with this lovely Cryptide community and check out some interesting topics as they pertain to the crypto space. I wanted to start off with kind of tongue-in-cheek humor that definitely rings true. Painful truth of crypto, nobody knows what you're talking about. And you can see here a lovely lady explaining some of the technical jargon that we use in this space pretty regularly, but ultimately somebody from the outside looks at us as if we have three heads like a hydra because they have no idea what this terminology means. This is something that affects all industries from all walks of life. However, the new and exciting technical innovations that crypto presents means that there's not a lot of prerequisite knowledge that individuals had time to intake in the general populace. So a lot of times when individuals hear these terms, they have no idea what's going on. They haven't had the prerequisite. And these include terms like double spend, Byzantine fault tolerance, Sybil resistance, and more. So I wanted to spend some time today just briefly to go into a back to basics point and talk about 51% attacks. Now, 51% attacks are something that are a feature, not so much a bug, of a cryptocurrency network, but have a huge potential array of implications that may or may not affect the network at any given time. And they're critical to have considering they are a fundamental part of how the network organizes the blockchain. Now, this is not a perfect explanation of a 51% attack. Thomas Carriz did a fantastic job of breaking down the important components and offering some great examples to help new and seasoned users alike conceptualize what a 51% attack is and what it can do and how it functions in a network. But as I said, it's not a perfect explanation. So if any of you have any contention with this or want to offer some sources to help to embellish what a 51% attack is and how it functions, please feel free to leave those below in the comments. But one thing is, of course, keep it civil and keep in mind we're talking to the layman. You don't want to be a Charlie Brown, you don't want to be a blockhead, and I'm guilty of that too. My head gets in the space and I'm looking at all these exciting innovations, and sometimes you pull yourself away from that and you realize that you sound like you're speaking Klingon to somebody who's never seen Star Trek. Not a good look. So let's go ahead and get back to basics as previously stated and examine what is a 51% attack courtesy of Thomas. Now, a 51% attack is considered in a way a chain reorganization. Essentially, and Thomas gives a great example here, assuming we have two groups of nodes, Group A and Group B. Well, in Bitcoin specifically, and in many, if not all, proof-of-work systems, what happens is if these groups of nodes aren't communicating with one another, they're moving along the order of blocks as they see fit, abiding by what's known as the longest chain rule. Essentially, the nodes come to an agreement that, hey, this is the longest chain, this has had the earliest solution, correct solution for a particular block, we'll add that on top of the last block, i.e. creating a blockchain. Makes sense, right? Now, what happens if Group A and Group B were to suddenly speak to one another and find out, oh no, we've added two different blocks on top of the previous blockchain, and they're not homogeneous. We have two different histories happening and unfolding before our very eyes. Well, luckily there's a mechanism to help to solve this issue known as the longest chain rule. So let's say in our hypothetical example that Group A solves the third block before Group B. When this occurs, Group B will subsequently throw out their chain and go with Group A because they now have the longest chain. This is what we mean when we say the longest chain rule and what we mean by a chain reorganization. Now, this can in some capacities be exploited, but it has some interesting features. This means essentially that let's say we're moving along just fine. Node group A and node group B have settled their differences using the longest chain rule and are now working diligently together. Well, interestingly enough, this demonstrates that finality, i.e., the payment's been sent, we're sure it's good, it's confirmed, is just probabilistic, which means there's always a increasingly small probability that the chain can be reorganized at a point in which your payment is invalidated. Said another way, if for some reason some chain that happened to have 10 blocks stacked on top of it ultimately was revealed to be not the longest chain, this would invalidate all 10 of those blocks, meaning certain payments that were included in those blocks would no longer be considered valid or final. Now, what this means is the 51% attack is not technically an attack on the network proper, but rather it is an attack or a feature that is executed on naive network participants. This isn't to say that the network participants are deficient or non-functioning, but naivety here simply serves to illustrate that they are naive or unknowing to the fact that there is a longer chain out there, and once they are made aware of this fact, must in turn, by the rules of consensus, abandon the shorter chain and start working on the longer chain. So this is just a way in which we just find a longer chain and ensure that the probabilistic transaction finality is as large as possible. This means that, let's say we wait for, in Bitcoin as an example, Tomas does a great job using the largest cryptocurrency we have available to us. Waiting about 30 blocks will give you a very, very in bold here, nice guarantee that the transaction will stay on chain. This is because the amount of hash power or energy needed to change up the Bitcoin blockchain after 30 blocks is a huge amount. Not only that, by then, all of the nodes, probabilistically, again, there's always that super small 0.001% chance or less that something may go awry. Essentially, after 30 blocks, the probability is so high that you could consider the transaction, for all intents and purposes in the human economy, final. Now, this gets into the mathematical concept of what is finality and when could we be considered final in terms of payment. And I think Tomas does a great job here because he says that realistically you should consider the amount of blocks that you consider a transaction to be final proportional to the amount of capital transferred. So if I'm transferring $5, maybe I can wait 10 blocks, and I'm like, hey, if by some act of fate, ultimately this transaction isn't final and the extremely infinitesimally low probability works out against my favor and my block is reorganized, it's just $5. Now, if I'm buying a new Ferrari or a new Lambo, let's use Lambo, it is crypto after all, and I'm transferring $1.3 million, maybe I don't want to wait 10 blocks. Maybe I want to wait 100 or even, 150 blocks before we consider this transaction final. That's to ensure that no chain reorganization is probable enough to affect the probabilistic transaction finality. So hopefully this can help to illustrate what a 51% attack is, how it is a feature of consensus, and ultimately how this should be considered proportional to the amount of capital being transferred. Again, wanted to give a shout out to Tomas. Great article, really helped me get in the headspace of getting back to basics and illustrating some of this information for those of you who may be excitingly watching this material but may not have a extremely firm grasp of all of the technicals, considering that indeed it is a very wide and detailed field. Tomas wrote a follow-up article talking about the different kinds of 51% attacks. Just for the sake of time, not going to go into a huge amount of detail here. Wanted to include it for your sake so you can check up on this kind of thing and do your own research. But suffice to say, wonderful examples. Again, kind of uses balls of energy to conceptualize overall hashing power or energy in the system. So yeah, definitely worth checking out. It'll be below in the description. Moving on, we have a bug bounty that was found in Coinbase's system. And this is a exciting bug bounty, not because of what it contained, but because it was worth, according to Coinbase, around $30,000 that was paid out to the programmer who was able to successfully identify this issue and go through honest bug disclosure, thereby allowing Coinbase to better protect its users and customers, and at the same time getting some of that sweet, sweet cash for their hard work. So congratulations to the programmer who was able to find this. Congratulations to Coinbase, and good on you for paying out a nice, healthy amount for this hard work. And also wanted to use this as an example to say, if you're a programmer, it's a bear market out there. there may not be huge amounts of demand for all kinds of skills, but as the learn to code meme says, there is always money in the banana stand of programming, and it seems very much worth it if you want to put your skills to the test for some of these larger entities in the crypto space, even in this frigid bear market. Now, here's another article I found absolutely insightful. Man, I can't tell you how impactful this article was to my own thinking. It's semi-rare that I stumble upon an article that is written in such a succinct and incestuous format. Yet so short in its content, yet delivers such a impactful punch to my way of conceptualizing digital assets. And really, John Pfeffer, I love his last name. No disrespect there, of course. You know, I have a goofy last name. But Pfeffer, really cool last name, definitely stuck out to me. And the content that he has been touching on is fantastic. The big takeaway is, if a crypto asset is not a dominant non-sovereign monetary store of value, it's somebody's working capital. That alone just blows my mind for so many reasons, because a lot of implications that can be taken out of that. But essentially, John argues that the viability of these long-term crypto assets are very low, specifically the utility tokens in a network, due to the fact that, excuse me, if a crypto asset is not a non-sovereign, i.e. not issued by the state, monetary store of value, meaning it is a store of value over time or hedge relative to other asset classes, it's somebody's working capital, meaning that it is capital that needs to be deployed for specific instances and payments over a predeterminate amount of time in order to offset financial obligations. And that's something that individuals want to keep, individuals and economic agents in general, as John calls them, want to keep to a minimum because of the opportunity cost of capital, because capital, when deployed, can make you money, etc. So it's something we want to minimize as economic agents, and that's something that is difficult to do in a utility token ecosystem, considering that the latency and the uncertainty of replenishment is minimized in these crypto ecosystems, which means that the velocity of these underlying assets will be comparatively insanely high. What this means is that there is a disproportionate amount of economic value in these crypto assets relative to how many people are holding them over time, etc. Remember, if they're not a store of value, then there's no reason to really hold them other than their utility. So what this means is you end up with a kind of lopsided situation in which the network itself is processing large amounts of economic activity, but the underlying tokenized asset that represents that value is comparatively low in value, as it is denominated in US dollars, euro, Ethereum, what have you. So what this means is the comparative and proportional cost of attacking such networks that host such large amounts of economic activity is comparatively low. Not a good situation, right? So essentially what this means is, as John sees it, the reasonable economic configuration for dApps on a larger network that acts as a comparatively stable store of value, the benefit for those dApps really is to charge fees, whether it be in the utility token or the specific store of value on the network on which the dApp is built. What this means is the utility token really doesn't need to exist in proper. Ultimately, the fee structure is where the value lies for these dApps. I know that's kind of a broad overview. It's a bit heady. I hope I was able to more succinctly break down John's Medium article here. If anybody has a chance to read over this and think I was a bit off base with my explanation, that was a bit off the cuff and on the fly, I tried to get a better idea of that before recording here. I think I did a pretty good job encapsulating it, but I can't stress enough how amazing this piece was. Really great and revolutionary for my own thinking, and I think perhaps for yours as well, if you really take some time to get intimate with this piece and digest what's being said here, because it has some great implications for the crypto space as a whole, and how we as individuals can maybe see the future of this space developing going forward, since, you know, a lot of the times putting the horse before the cart is the way to go, but all too often when we're in these early stages, kind of the primordial ooze of building this new economy. I know new economy is it's a word that's been in vogue every time a new bubble comes. essentially, it seems that we put a lot of the times the cart before the horse. And I think this is something that John was able to successfully identify here. Really great stuff. All right, now let's get into the meat of the matter, the news of the day, the thing that really gets your gears turning in terms of relevant information as it pertains to the immediacy, not so much the long term of adoption. Apple. Apple, Apple, Apple. It's everybody's favorite fruit. It's Johnny Appleseed after all. And that seems to be a role that Tim Cook is filling quite well as the modern technological Johnny Appleseed. Apple recently filed a patent talking about how they are worried deeply about not only individual user protection and privacy, but also about individuals who are producing their goods and soliciting and eliciting rather their services. And in this demonstration, essentially, it shows that Apple is involved in drafting blockchain guidelines. Now, no word yet as to whether or not we're going to be getting iChain. I love what the author Stan here called it, the iChain. Whoops. So yeah, iChain would be assumingly what they would call it. It'd be pretty humorous. So no word yet as to whether or not Apple's going to be using any kind of blockchain technology to track the development processes of its products and where a lot of these items are being sourced from. I think that would be a very unique application, and the big question here would be not if that's something Apple will do, but when Apple will ultimately implement a product tracking using some kind of modern database, whether it be distributed, proprietary, or otherwise. But the big question for me is it going to be proprietary? Will Apple utilize, let's say, Amazon's consortium of blockchain services and build something on top of Hyperledger using that portal? Will they build something of their own on top of Hyperledger, or perhaps iChain will be something unique and all of its own? I know there's plenty of projects out there that I'm sure are focused on supply chain or checking this out, or like, oh man, this is us, guys, this is us. So plenty of options out there for sure. Let me know what you think about this kind of thing below in the comments. Could it be VeChain? Could it be proprietary? Could it be Hyperledger? It could really go either way. Or maybe Consensus will take a piece of the pie yet again and have them build it on Ethereum. Who knows? All right, one thing's for sure, NASDAQ, they're making waves. We talk about them semi-regularly. They always have stuff going on in the crypto space. Not only are they dealing in blockchain proper in terms of technology and implementation, but they're also helping to get the information into the hands and in front of the eyes of the individuals, institutional, retail, or otherwise, who are trying to discern the best methods by which they can weight this information. After all, there's tons of it in this digital economy. And they're setting forth a Bitcoin and Ethereum index for real-time spot price discovery. And this is in partnership with where are they at? There you go, Brave New Coin. Brave New Coin has been around for a good while now, and they have all kinds of insights, data charts, enterprise solutions, which assumingly that's what NASDAQ would go for. And at a glance for retail investors such as ourselves, we have Bitcoin Liquid Index and the Ethereum Liquid Index, which is an aggregate from a multiplicity of various sources and can give you a better idea as to what the underlying price of some of these digital assets are. And this is the way the world seems to be going, bridging the gap between institutional investors who are looking to get accurate information about the space and the wild west of pump and dumps, wash trading, fake figures, and all of that sort of thing that goes along with it. And it's exciting to see the space mature in such a way. This does call into question, though, some elements of relative centralization, and I think it's much more of a broad spectrum rather than a binary. And that's something we can see here. Two centralized entities, one very much traditional, and one that is on the cutting edge of digital finance, helping to bridge the gap between the decentralized digital world and the existing lumbering behemoth with huge amounts of pent-up capital that they're looking to put to work. Remember, one thing we got to keep in mind is, where's it at? Oh man, I had it here. Yep, the opportunity cost of capital. There it is. The opportunity cost of capital. And that's something that NASDAQ no doubt has in mind, and that's why they're offering this kind of information fluidly to their users. And of course, we have governments always involved in the new and exciting technology we have going on here and trying to offer guidance the best way they possibly can, for better or for worse. And of course, Miss Hester Pierce has yet again gone in front of the SEC, as she is a commissioner there, and has confirmed that guidance is occurring in terms of crypto tokens and digital assets. We have the Howey test, which is currently serving as the barometer for the United States. It offers some great information and can help users discern whether or not their project is potentially skirting security law, something that most, assumingly, ICOs would want to avoid, and ICOs really are kind of falling out of favor for what seems to be security tokens offering, or STOs. Whether or not that's just a repackaging of ICOs in order to skirt this kind of bleeding edge of legality is yet to be seen. However, to quote Mrs. Pierce, if we act appropriately, we can enable innovation on this new frontier to proceed without compromising the objectives of our securities laws. It's a difficult plural there. Protecting investors, facilitating capital formation, and ensuring fair, orderly, and efficient markets. Ultimately, that's what this is all about. Fair, maybe not so much in markets. After all, in markets, there's always winners or losers. Orderly and efficient, though, absolutely. At least some kind of standard by which individuals can gauge whether or not the information they're looking at is as close to objective as possible. There's no such thing as no bias or objectivity. It's what we can strive for largely, and account for our own biases as we strive to give the best information possible. However, in terms of fairness, maybe not so much, but having the access to the best information is definitely something I think everybody can get behind. Otherwise, it's kind of a nefarious space overall where some individuals benefit at the expense of the vast majority, and that's what I think not many people, a very small minority of individuals ultimately want. But unfortunately, sometimes those individuals have great influence. And a lot of the times their ICOs look like this. Here's Howiecoin. This is from the SEC, from the federal government, to let you know what a more scammy token sale may look like. You can see here, first things first, they're letting you know that there's a bonus, and that here's how the countdown is proceeding. Good stuff there. That's not suspicious in and of itself, but a lot of the time what's suspicious is this is minimalistic. It's kind of shoddily thrown together. You have this kind of clip art that you can pull from the internet. Yo, look, 25% discount. That's exciting, looking great. But basically they try and juice you with all these discounts. These aren't real people, or rather they are real. They're real people. They're out there. They're doing stuff. But they're definitely not the co-founder and head architect of Howiecoin. A lot of this can be done by reverse Google image searching, kind of doing your own research there. But just keeping an open mind and having mental scrutiny, critical thought about these kind of things, thinking, what is my recourse here? Where are these people based? I need to do more due diligence about who these people are, where they're from, what their background is, what's the token utility, what's it looking like, what legal jurisdiction could this potentially be settled in if there is a discrepancy. Tezos users found themselves in a pickle when they realized, after investing in the Tezos ICO, that not only was the legal jurisdiction Switzerland, but also it was a donation. Literally in the Tezos ICO legal contract, it says you are donating capital for which you may or may not receive Tezos tokens, or Tezis as they're so lovingly called. Many individuals, the vast majority assumingly, did not realize this. So this is why researching these kind of things are so important. An individual who just had this placed in front of them, maybe nestled into a list of other legitimate ICOs, maybe they wouldn't bat an eye and they would think, oh, this must be legitimate. The other one seemed legitimate. This will be fine. This is why doing your own research is so important, and taking your time, sleeping on these kind of decisions. You see, 15%, 14 days, I have to hurry. That emotional response is exactly what these type of projects are hoping to elicit in you in order to get you to make a less than wise and incestuous financial decision. Definitely not the best financial decision you could potentially make, considering this is an SEC honeypot. No good. All right, next up we have Argentina. They settled an export deal with Paraguay for $7,100 in various pesticides and fumigation products. They're looking essentially to circumnavigate the SWIFT system, something that many nations around the world, including Russia, Iran, and other nations such as China, they don't want to deal with the payment system that ultimately seems to be, for all intents and purposes, controlled by Western powers. This has unexpected and unwelcome caveats, such as the Iranian sanctions. They can try and do business with China, but if they're going to use the SWIFT system, well, those payments could be locked out due to sanctions. Now, this is a unique way to kind of circumnavigate this existing behemoth of a system, considering instead of just transferring Argentinian pesos to Paraguayan dollars, pesos, not sure off the top of my head what they use there actually, interestingly enough, but suffice to say, instead of just doing that, they went through Bitcoin. I'm assuming they're doing that to log the actual transaction on a larger network that is decentralized and robust. But one of the arguments I've heard is, why would they not just transfer capital back and forth between themselves using a proprietary system. There are many reasons I can think of as to why they would just avoid using Bitcoin or why they would want to use Bitcoin. As said, one of the reasons in terms of the pro category is you're able to attest this data to a very robust, decentralized, unpermissioned chain, well, semi-permissioned chain. And on the con list, you're really just paying extra transaction fees that vary wildly relative to the underlying asset and network usage. So why would you do that? Really, again, it could go either way. There's plenty of reasons for both categories. Let me know what you think below in the comments. Is this kind of a novel application, more experimental, or do you think this could become the new norm for nations who are trying to avoid the SWIFT system and circumvent that centralized mechanism of control over their sovereign finance? Now, we're going to wrap up here talking about, I don't want to call it fake news, it's definitely real news, but the implications for some of the implications for the news ultimately are not all it's cracked up to be, and I found it very interesting that the Daily Hodl would include this information. 10,000 retail shops in France will sell Bitcoin, XRP, Ethereum, Litecoin, and Dash, powered by Ingenico. So this is exciting, really cool stuff. We heard recently that in France, the tobacco shops will begin selling Bitcoin via ATMs and other services as well, so that's really neat. However, the point of contention we're taking with this article is this section here. A few Crypto Coffee updates ago, I included some information about Ripple/XRP. The two are intrinsically, but not potentially legally related. There's some complications there. However, this is the point of contention. When you look at the source itself, the local news outlet Cryptonaut, go over here. I actually don't speak nor read French, but one thing's for sure, XRP is not listed anywhere in this article. You can actually Control F XRP, which I did before. The only place XRP is listed is... actually doesn't show it, but Ripple itself is in 3 places, different article, and somewhere on the website, don't know where, doesn't actually take us anywhere. But I found this really interesting, considering that maybe this was a method by which the Daily Hodl hoped to include Ripple to gain more clicks. Alternative opinion, maybe they just accidentally included it because this was kind of like the top dogs, the big front-running cryptocurrencies. So maybe the author just kind of mentally was like, oh yeah, we'll just include that into here without thinking about it, didn't actually do the due diligence, or maybe they did and it was just an honest mistake. Really, there's no way to know other than by reaching out to the Daily Hodl staff, which we could do. If you guys feel so inclined, let me know. But really, I just wanted to use this as an example as to why we here at Cryptide and why I believe all individuals should check out the source, try and do some deep dives and get to the meat of the matter, the real primary source of the material, because sometimes extrapolations can be made in earnest, honestly, just a mistake, or otherwise, sometimes for more nefarious purposes in which individuals wish to sway your opinion one way or the other, sometimes for fun, but most of the time for their own subjective financial gain. And that's why we don't do any pump and dump, anything like that. I find it so wild that that's something that exists in the space, since the risk reward comparatively is not in anyone's favor financially. Definitely not that great. So yeah, just wanted to point that out. And of course, not insinuating that's what the Daily Hodl did, really just kind of bringing attention to the fact that news can be misconstrued in all segments and walks of life. So we'll go ahead and end with that. With that said, thank you so much for watching, guys. It has been a pleasure. I always enjoy having these little powwows with you guys and getting this information out there. Let me know if you enjoyed it as well and what you think of this kind of content below in the comments, or join the Discord, link below in the description as well. And we can have some great dialogue about this kind of stuff and more. We got individuals posting charts, technical analysis, fundamental analysis, news, events, conferences happening real time, live every day. So yeah, check us out. Thanks again for watching, guys. My name is Paul. We are Cryptide, and remember, the tide is rising, as is the list of coins included in this article with each subsequent reiteration.